Warning. This podcast features the truth about owning and operating mobile home parks. The following program is not designed to be sexy. It will not hype you up on MHPs. Rather, this is a raw take on this industry and how you find your own path to success. Welcome to MHP IRL, Mobile Home Parks in Real Life, with your host, Ryan Norris.
Well, everybody, I would like to welcome Kolman Bubis. He is an absolute rock star broker and quite possibly one of the smartest people I have met in the space. I've connected with over 1,000 people. And one thing I absolutely love about Kolman and why I wanted to bring him on to my podcast is because I don't think in 3 years of knowing Kolman, I've had a single conversation with him where I haven't gone, I haven't thought about it that way. So Kolman, no pressure.
Yeah.
I'm excited to have you.
Great to be on with you guys.
Yeah. So give a little shout to your painting back there.
That is a vintage mobile home print that I found in Nashville one year after the George Allen conference. I was messing around at the Hatch Gallery, which still has their printing press from the early 1900s. And this was actually a real Ritz-Craft advertisement from the 70s, I believe. So I had to get a copy of it and put it up in the office. We found some other cool stuff there. So if you're ever in Nashville, go there and get yourself a copy as well. They got a couple cool Airstream ones and some other, much larger vintage mobile home ads that you can buy.
I love it. And by the way, if we have some time, I totally want to hear some Bob stories. And anyone who doesn't know the Kolman and Bob duo, they've definitely gotten into some crazy, interesting shenanigans. But, well, dude, if you don't mind, I just want to jump right into this. And just to get right to the main theme that I want to talk about today, it's what qualities make a mobile home park not trade. And to just give a little background to why I want to focus on that, I think we all agree that are listening in, we've seen nothing over the years but prices going up and cap rates going down. And I get it. For a lot of reasons it makes sense, especially because we think that this niche product has been undervalued over the years and rents are continually on the rise. But I've seen people raise tens of millions of dollars and make some big bets. So what I want to know to help my audience better prepare for risk is, in your experience, because you've seen so many deals over the years, what risks are people not thinking of? That's if someone's going to overpay for something, what do they need to think about? Which, in your experience, when you've seen a deal not trade, why is that?
Sure. Yeah, no, it's a tough question with a lot of layers to it. And, I think that's maybe the first thing to talk about is that sometimes, new people in the industry or, people try to do a lot of what I'll call desktop due diligence. Desktop due diligence is a great tool. It's one that should be in your chest, but at the end of the day, real estate on its most basic level, every piece of it is unique and has some, nuances or challenges or opportunities. And really the only way to get the full grasp of that is, visiting the immediate area, visiting the community itself. And then eventually in your on-site due diligence, really, getting out there and walking the asset and looking at lots and looking at the infrastructure, because if we were investing in bonds, we wouldn't really have to do much diligence beyond just, do you like the fundamental base of the company? Here, we're buying a unique piece of real estate, and everyone has a lot of differences. So you really have to start to put a chart together, which you guys, I think, have done a nice job in sharing on some of the Facebook groups, is really just starting to create a checklist for yourself of like, what are the various factors of the property? I mean, let's start with the most basic one, which is the fundamental real estate. And, location, like everything else, is the most important factor. I've seen, frankly, dumpy trailer parks in good locations that are full and make a lot of money, because this is ultimately a driver business based upon housing costs. And where housing costs are high, there's demand for manufactured housing, in the middle of nowhere, or where there's places like, the Southeast, for example, your area, you see a lot of mobile homes on private land, which is a function of housing costs being low in super rural areas. But, within that, you really need to start to put together a checklist of like, what are the things I need to look at the first being the location, of course. Like you can change a property with time and, more importantly, money. But you obviously can't change the intrinsic location, the market, the submarket, to make that better. So if you're comfortable with the location, then I think you start to move down your list of the biggest ones in this business that you can get hurt on, of course, is infrastructure, utilities, underground infrastructure, utility systems, be it water, sewer, gas, electric, common area buildings, if there are any, roads. Mobile home parks are pretty simple construction, and really, for development purposes, one of the easiest things are to build. You're building roads and underground utilities. So those are the things, you need to focus on in your due diligence, assuming you're comfortable with the location and the market. And then after that, homes and obviously environmental issues are one that pop up in every type of real estate, and they're important here. Lastly, and then I'll throw it back to you, a couple of the other ones, of course, are going to be the city itself and the floodplain. We have seen some cities start to enact legislation within their cities, which in some cases I think is potentially illegal or discriminatory in housing. But those are kind of the main factors, besides flood and municipal level, of highlights that should be on your checklist when you're looking at the physical asset, and frankly, where a lot of the risk is.
That's a great answer, and I couldn't agree more. It boils down to location, because at the end of the day, location. We all know that. And infrastructure, which I just don't hear enough people talking about. I literally did last week exactly what you just said right there, which on a property I have under contract, 80 lots, I went through literally every single lot, looking at the septics, the water lines, and the electrical boxes at a minimum to understand how much capital I was going to need to bring in homes. It's the one thing that will absolutely crush you. Like I talk about on my podcast, my second deal ever, we didn't check the water bills, and we ended up having to dump $150,000 into fixing the water lines because we were losing about over $20,000 a year to the ground. So I couldn't agree more. Location is absolutely crucial. And for a lot of folks raising money, they get hooked on this idea of yield, and they start chasing tertiary markets in the middle of nowhere, which might be great while the economy is good and you're hitting your APREF or whatever you're chasing after. But what I would ask of you to kind of give some more color to, Kolman, is for people just obsessively chasing yield, how much risk do you think they're taking by buying something that might cash flow well right now, but it's in the middle of nowhere, like say next to a power plant in the middle of nowhere, and that goes down? Like, what's keeping people in the town?
Yeah, no, I think that's a good point. And right now, with interest rates and bond yields as low as they are, there's a lot of savers. You used to be able to, in our fathers and grandfathers' lives, create bond ladders for yourself that would create a lot of passive income. And now, with rates as low as they are, the world is really starved of predictable yield. And that's what mobile home parks can offer. But to your point, for the people that are raising money, it kind of actually flows into what I was talking about with Kevin Bupp and some other guys on their podcast is setting up your structure and how you scale in the business too. Because the biggest problem I see for operators, especially on the smaller scale, once you get to a certain point, you realize how important it is in the business. But the unforeseen yield and the hard yield to predict is really like on the home side of the business. And I think that's one of the most underthought about things for new operators is like, how am I going to fund a home business? Because in ways, MHC is a lot like office in that you need a lot of working capital to infill a project or to really take a trailer park into a manufactured housing community, and be it whatever strategy it is, rehabbing vacant existing homes, bringing in used homes, or frankly, where I think the smart operators and the sophisticated operators are going is you need a mechanism to bring in new homes, because to onesie, twosie, a couple refurb homes, I mean, that's great, but you can sometimes be buying more headache than opportunity. So that's really the undercapitalized or underthought about people's aspects of their capital raises and their operations is, how am I going to keep this property full? And in some sense, right, we kind of have a rental car lot, whether the resident actually owns a home or not. But if you pretty up the roads and you pretty up the sign and you pretty up the clubhouse or the office or whatever it may be. You never really touch the homes. You've kind of got that nice looking rental car lot, and then you're renting, the 60s Pintos or 70s Pintos. And the best residents, the better residents, they don't want to live in that home. So I think that's one thing for people to start thinking about, is whether I'm raising additional capital and equity, I'm using 21st if we really don't have a lot of capital, I'm getting lines of credit from lenders. Start thinking through like that factor, because that really can suck a lot of cash as well. If you're in a small town and you get a lot of turnover at once, you're going to have to go in there and rehab those homes and resell them or re-rent them. And that can suck up a lot of capital as well, which at the end of the day ultimately flows into your overall yield, which is where I was circling back to on. So yield is an interesting thing, right? There's obviously, whether you're looking at bonds or you're looking at multifamily or you're looking at mobile home parks, really, in some ways, yield is representative of risk. And to your point, some of these, sexier looking on paper, higher yielding assets, the reason that they're throwing off that type of yield is because there's intrinsically more risk with the market, or there's intrinsically more risk with the quality of the asset. It's tough to get new good people into, the rundown trailer park, because good residents just don't want to live like that. So those are really the things that, risk looks good on paper and on an Excel spreadsheet. But, to your point, if you've got all of your residents working in one base, or the other biggest factor I really see is housing costs, right? If people can go buy a site-built home for $75,000 up the road or $50,000, it's going to be really difficult to sell them a new home for $50,000, and that probably really becomes a used home market. But that doesn't necessarily mean that there can't be yield. I think in-place yield is one thing to look at, but also, with good operations, where can you take that yield? And that's really, I think, what a lot of people, especially yourself, are looking for is, you're not really buying it for the in-place yield. You're buying it for, if I really put capital into this and I stabilize the asset, where can I actually take the yield? So I like to focus people away from just looking at in-place cap rates and just starting to understand the underlying debt, and really more so the bread and butter is like, what can you do here operationally that's going to drive your net operating income and ultimately your yield? So people really need to understand that this is a heavily intensive operating business. And if you don't have a plan for how you're going to run the asset and run it well and put time into it, you're not going to be getting your yields in what I would say an armchair type operational situation.
So really two things that I get asked all the time: park-owned homes and vacant pads. So if I'm a syndicator, I raise $20 million and I am disappointed that I can't find 8 caps everywhere. And so I go, all right, I want value add. Here are park-owned homes. I hear I can make more money doing those. Here are vacant pads. I can bring in brand new homes and up the quality of the community. If I fail doing that, from your perspective as a broker, do you get excited to sell heavy park-owned home communities, or does that really matter? Do you get excited to sell communities with a lot of vacant pads, or does the market really view those as, oh, that's going to be a lot more work, a lot more capital? I'd rather just have all tenant-owned homes so I get a bump in my valuation if it's all tenant-owned or all occupied.
Sure. Yeah. And listen, there is a valuation difference, in a community that's all tenant-owned, but I would say that that range of what it used to be has narrowed more recently, because at the end of the day, to be successful in the business, I think you frankly have to be involved in homes, right? It's the only way to continue to drive the occupancy, turn a community's leaf, make it nicer. So you've got to be involved. And those that are involved in really the home business, they understand that in most cases, there are circumstances, but in most markets, putting new homes in is what I would call a bit of a loss leader. You're not really making money. In some cases, you're losing some money. But where you're making those dollars up is in the value of occupied sites and growing, your net operating income, which can then be capitalized. So, you want to be cognizant of that depending on the community. Listen, resident-owned communities are much easier to manage. And if you can sell homes in your market, I'd encourage you to do so, or you get a lower turnover resident. But value add deals, right, if you've got to fill 50 or 60 or 70 sites, I think that the quickest way to do it is a combination of sales and rentals. And of course, your rentals are going to turn over on average every 18 months, where your resident owned is going to stay for 5 to 7 years on average. So be careful what you wish for, but I really think it depends on the asset and what you're trying to do there. And almost every transaction that we're doing, there is some component of chattel involved. So people need to get into the mindset that this is a piece of the business. It's an asset of the business. It does produce cash flow in a lot of cases, very, very nice cash flow on the homes themselves. But ultimately, that cash flow isn't really looked at and valued the same way as the lot rent. So craft your strategy based upon your market, what the market wants, and ultimately what you're trying to do there. I think the add value nature, people getting into add value deals with high vacancy has definitely become more attractive if they have capital to infill homes and they believe in the market. So on, some recent kind of heavy lift, high vacancy deals, we've had a lot of interest because people think that, if I can't buy good going in yield, I might as well buy good price per pound and then deploy the capital to ultimately get that up. Because, mobile home parks are interesting in the regard of expenses, right? When you get a 95% occupied property with really high lot rents, that expense ratio starts to get really low. But when you have a 50% occupied property, because there's so many fixed expenses, you really start to get into a situation where you don't have a lot of net operating income. And in that case, right, a cap rate valuation isn't really kind of your best approach. You start to look at the intrinsics and the replacement costs of the sites. So yeah, it's an interesting world out there with what people are chasing. And, really depending on your amount of capital and your propensity to take on risk, that's where you need to focus, right? Putting in a lot of homes is a lot of work. It really, really does, if you do it right. Laying them out correctly, the right size home for the right lot, the right site prep ahead of time, depending on your strategies. So all those kind of moving parts create more risk, which, ultimately can give you higher yields if you have a good plan and can execute on it.
So I've seen a lot of apartment people with no mobile home park experience flood the space and really help drive the prices up and cap rates down. Do you think that's a big reason why park-owned homes are not necessarily looked down as much on because these apartment folks are used to the rental space?
Yeah, I think at the end of the day, park-owned home used to be kind of a bit of a dirty word, shall we say. And the truth of the matter is no one really wants to be in the home business, but it's a function of you really have to be in the home business because it's the only way to really change the curb appeal of a property is infuse new homes. And it's really the only way to drive occupancy, because to find, 50 used homes is just going to take a ton of time. So, and I think the truth of the matter is the new homes really, really changed the dynamic of the industry, changed the tenant base, changed the interest level and the curb appeal. So it's gotten more widely accepted because there's a real need for it. And even lenders who obviously don't want to lend on homes besides specialty lenders, you've got to explain to them, like, listen, you want me as a borrower in the home business because I'm really improving your collateral, which is the real estate, even if you don't own those homes. So I think the reality is the business has evolved over time. And if you're not in the homes business, in some regard, right, you're really not in the business. You've got an asset that's sitting with an aging stock of homes. So you need to get involved in the business. And I think back to what we were talking about, scaling the business, if you have 1 or 2 communities, it's not as important. But if you hope to grow to 5, 10, 15, 20 communities or more, you really need to have a plan for how you're going to scale your home operations, because it's a huge part of the business and you need to be thinking about it, whether you own 1 park or 50.
I couldn't agree more. I don't think enough people think through what happens if someone defaults and they don't own their home and the community doesn't own that home. You will be in the park-owned home business if you are in this business, period. Talk to me about this. I've seen a lot of folks feel the urge to place capital, understandably, very quickly, and they start out trying with a really tight-knit geographical footprint. And then what ends up happening is they're in Texas and then Florida and then South Carolina and then New York. And all of a sudden you have this huge portfolio that's everywhere. And you can't realistically merge management if you're in Texas and Florida and South Carolina. Talk to me about, from your perspective as a broker, the value of having something really tight knit? And also, how have you seen in your experience over the years trying to manage some 14 parks in 14 states?
Yeah, no, I think that's a great question, and different amounts of capital and desires for capital need different things. I think there's value in going both ways. To be in one place and to buy a 40 space here and a 60 space there and 75 somewhere else, that becomes tough. But if you can actually find larger deals, then it becomes easier to scale, because the closer you are geographically to a property, the easier it is for you to manage, right? Because you can go out there and see. When it's farther away, frankly, you need to be able to afford to pay better quality managers to help you run those day-to-day operations is my experience. And the difference in what you get for a manager for 30 grand and 50 grand per year is significantly different. You get a better quality person, but if you've got 50 lots here and 50 there, you really can't afford to pay that quality of manager. So in that case, I like your strategy on a geographic basis, right? Like once you're there, it's great to try to scale. If you're going to go to somewhere new, it's nice to have a little bit more scale going in. Or you could take the mindset of like, hey, I might overpay to enter the market a little bit, but once I'm there and I can scale a little bit, then it will make more economic sense. So I think either strategy works. I mean, there's successful operators who are running properties all over the country, and there's successful operators who've taken a very, very specific geographic approach. The only negative on your approach is that, yeah, it's nice that you have close scale, but if it's a 20 space park and a 40 and a 60, like that's still never going to be the one. It's still never going to be valued the same as one 200 unit community,
right? Just
because of the scattered site locations. They will certainly all be worth more together than on their own. But at the same time, 3 small parks that add up to 200 sites is not the same as 200 sites in one location.
Yeah, I couldn't agree more. That's the biggest flaw in my strategy is, you can't really hire someone until you have about 100 lots. And it's great that I own 25 lots in Salisbury, North Carolina, but the rest of my Charlotte stuff is in Gaston County pretty much. That's not close. I mean, it's 45 to an hour for my manager to get all the way over there, which is a problem, right? And if I'm private equity money and I want to buy my Charlotte portfolio, which is pushing 200 lots across 5 properties, can you really count Salisbury? Not really.
In that case, we're kind of forcing them to take it unless we feel like we have a better one-off buyer. So you can force them to take it, but it's not as desirable. You're absolutely right. For a larger, more institutionalized operator to want to add on, the 25 space that's not really in the footprint of the rest of the asset.
It also affects scalability. Now, I don't have outside money. I've been very fortunate to have sold out of a few of mine, have my own cash, and that's it, which is wonderful. So I don't have that pressure. But if I had that pressure, I would not be scaling fast enough. And so I think that's good for those people to hear that have raised like $20 million that, hey, guess what? It's okay. Just buy bigger.
Yeah. Well, that's always been the fundamental, I wouldn't say problem, right? That's always been the fundamental barrier to entry in some regards for larger groups. They've always had interest in this space, but it's more difficult now than ever to deploy the amount of equity wisely that they want to because of the finite number of communities and the low velocity. I mean, it's not only is it a small stock of communities, it's also a stock that has low velocity sales wise.
So from your perspective, as long as you have the scale, so call it 200, 150, 200 plus in a market, from your perspective, a management of multi-states and sale of a portfolio of multi-states aren't really that dramatically rocked as long as you have scale.
Sure. Scale solves anything, right? Like scale, you might not get, right, the RHPs of the world, the Sun Communities of the world, the really large operators to look at something like yours. But the larger you can make it, the more attractive it is for another operator who might have some institutional capital or a family office or something like that. So scale in one geographic market, unless it's a market that's dying on the vine, and I won't name any out of respect for some of those markets, but we've all heard of, the areas that we feel are losing population, have economic issues, et cetera, et cetera. So that's the only negative to scaling so much in one market, right? Is if you do have some issues in that town or employment-wise, et cetera, you do have a lot of eggs in one basket. But operationally efficient, the more you can scale in one area, the more you can share resources, pool managers, maintenance, and third-party vendors.
I think this is a good segue into hyping up your market. So you are like the king of the Midwest. And when you look at the numbers from CBRE, JLL, Northmark, it pops off the page how much better in terms if you're a buyer of a mobile home park, the Midwest is. But at the same time, when you look at a lot of those cities, I'm from Cleveland, Ohio. Numbers don't look overly great in the land. Why Midwest? What are the pros and cons? What should I be thinking through if I'm looking at the Midwest?
Yeah, no, I think the Midwest is the thing about it is you see a lot of trades in the Midwest because there is a lot of stock. And the surprising one is Michigan, really. I mean, we've always talked about it internally in our team. Michigan has the third largest concentration of mobile home parks behind Florida and California. And that was surprising to me when I first learned that. But then, there's also a large concentration of communities in Indiana and Illinois and in Ohio. So just by pure numbers, there's a lot of velocity because there's a lot of stock. But like any town, right? There's good parts of Los Angeles, there's good parts of Chicago, there's certainly nice markets in Cleveland. But you got to do a little bit of research to get yourself smart on that market if you're not familiar with it, back to the boots on the ground of driving around and looking at the area and the competition. So there is higher yields in the Midwest. And I think there's a lot of opportunities. Like Illinois, for example, right now, we've gotten a big slowdown in sales velocity because of a perception that Illinois is in financial troubles, that the taxes are really high. And the funny thing is that the state of Illinois certainly is not very exciting when you look at their underlying pension deficits and finances. But at the same time, the dirty little secret is that Cook County is really the only one that's super aggressive on real estate taxes here in Metro Chicago. When you get out into the smaller markets, they're frankly not as aggressive as people think on reassessing real estate taxes. And in fact, in my experience, Michigan is more aggressive in chasing sales taxes. And keep that in mind, again, that's outside of Cook County where they are aggressive. So I almost think the knife on Illinois has fallen a little too far and people are scared to come into the state because of what they're hearing. The reality is a lot of these markets aren't going anywhere. They're not going to 5x your taxes the day you close in, central Illinois or, some of the other northern Illinois counties outside Cook County. I mean, we've had some stuff that, 9, 10 cap type properties with some upside that, weren't getting a lot of interest just because they were in Illinois. So like anywhere else, be it even Florida, right? I grew up in Florida. There's good pockets of Florida and there's less desirable pockets of Florida. So really do your research on the Midwest. And if you want my thoughts, give me a call and we can talk about the town and the community. We've probably driven it at some point and try to give you some help, even if we're not really involved in the deal.
I'll leave your contact information in the show notes for anyone who wants to reach out to Kolman. So that really reminds me of this phrase, real estate is like legal insider trading. I love that. And that's, to me, exactly what you just said right there. If you do your research on the markets, what you'll find is there are kind of inconsistencies amongst the general consensus on an area, and you can find a submarket and absolutely crush it. I'll give you a good, for example, a mutual friend of ours is gung-ho about New York State, and everyone's terrified of New York State right now because of the rental laws. But the thing is, this guy's a lawyer. What better person to really thoroughly understand what he can and cannot do within the law and be able to have the confidence to continue to fight ridiculous rent laws? And just for anyone listening in, I think, Kolman, the biggest takeaway I got out of what you just explained right there is that if you do your research, you'll find a lot of times there's stuff hidden within the hype that you can take advantage of.
Absolutely. Warren Buffett's famous line, be greedy when others are fearful.
Right.
And it kind of echoes like rent control markets, right? There's some owner-operators in the business that have really become experts on rent control. And where most of us would be fearful of that, they feel confident because they understand the law and they understand those stipulations better than others. New York, similar type situation. But I mean, even here in Metro Chicago, same thing with Cook County. But where there's regulation, there's also $800 lot rents. So, and high housing costs. So the demand for housing is high. So I agree with you. And I talked about this on a podcast yesterday with like private utilities. That should not be an automatic deal killer, right? Get smart on the system. And yeah, there might be a problem with the system, but I saw one well system where the family had overhauled the whole well, $150,000 well upgrades, pressurized tanks, beautiful new well building. That shouldn't be scary if they've got modern state-of-the-art well equipment that frankly is way cheaper to run than buying water from the city.
Yeah, I haven't
smart on the private utilities and local market regulations, because that could be a strategic advantage.
I absolutely love that you said that, because it's another point that I want to bring up, which is that just because you're public utilities does not mean you're out of the clear. I mean, I literally right now have an easement situation with the city in one of my communities. It's all public water, public sewer. And I have a massive situation on my hands that has been ongoing for years. And then I also have this wonderful little itsy bitsy community with a wonderful well and wonderful septics. And I don't ever have to think about it, especially when you get on a good pump schedule for your septics. And if you have a great well company that go above and beyond what the call of duty is, it's easy.
Yeah. And if you're in due diligence on those properties, and you call those third-party vendors, right? Like the well operator, the sewer treatment facility or septic operator, like they're not really gonna hold back. They're gonna tell you the good, the bad, and the ugly about the system. Of course, like environmental companies, be cognizant that they might want to create some work for themselves,
right?
But they also, are going to give you the honest look on what's going on with the system and what they're seeing and what invoices the current owner is getting on for operational costs versus CapEx improvement costs.
This could transition into my next question, which is, how have you seen poor management rock the valuation on a mobile home park over the years?
Yeah, it's one of my concerns or I would say observations about a lot of new entrants into the space over the last 5 years is that a big owner in the space who I respect a lot once told me that your property is only as good as your manager and your operations. And that's really the most underserved side, is that, you're really betting on the operator, because it is sometimes we like to call it hand combat type business, where you've got to talk to the residents, you got to solve their issues. And with bad operations, you can really see a lot of value implode very quickly.
Yeah. And even with decent operations and one piece of that game missing, it can make a big difference. I mean, literally 2 weeks ago, we had an in-place resident on a property we just closed on threatened to burn her mobile home down. And that was 100% because the last guy was like, I need money, just get him in. And otherwise he had some contracts that he negotiated with the local companies like trash and landscaping that I personally have never been able to pull off. So he was great in some regards and terrible in the other. You have to have a complete game to really maximize it. But Kolman, where I want to end off here is I really want to have you kind of tell everyone because I want this to be all about risk, right? Because there's a lot of hype on our industry, which is great, but hype without understanding risk is just a recipe for disaster. In your opinion, what is not talked enough about? What is ignored? What is downplayed? Or what do people flat out not consider that you really want people to, from a risk standpoint, people to spend more time focusing on?
I think I'll go back to the infrastructure is obvious, right? If you got massive potholes in the road or something like that. But I want to go back to the home side of the business and beat on that for another moment or so, because it really is the core of the business. The home creates the lot rent. The lot rent creates the value. With no home, you've got no lot rent. So really start to think about, how am I going to fund, capitalize, and operate the home business? Because it really is the heartbeat. And I think a lot of new people just don't really understand that. They want the lot rent. And we all want the lot rent, but the home business is the necessary evil to get to the lot rent. So really start to think about, like, am I going to use 21st? Am I going to get a line of credit from my bank? Who are the different specialty lenders that are in that space? And how am I going to capitalize, my home program? Because that and having ample working capital for home turns or homes that get vacated is critical. And I think a lot of new people are underfunding and under anticipating that side of the business. So get smart on the home side of the business, and that will make you be able to take on different risks. Like at first, you probably don't want to take on the 50% occupied heavy infill because frankly, there is more risk there. But the more you get comfortable with homes and infilling them and financing them and or renting them, right? Some people love rental homes. The more comfortable you're going to be taking on additional risk later on, which, right, with more risk, there is more rewards. So get smart on the homes.
Well, everybody, if you don't already know Kolman, is whether you're in the Midwest or want to be in the Midwest or not, you need to know Kolman and his crew. So I'm going to leave your contact information, Kolman, in the show notes.
Most appreciated.
As always, man, you've absolutely delivered some wonderful wisdom nuggets you dropped there. Thanks again for coming on.
Yeah, no, I appreciate the invite. Always love getting on and chatting with you guys. And that's a beautiful part about this business that I love, is that we can make a lot of money. We can also really change the dynamic of affordable housing communities here. So let's keep sharing the information, and there's enough to go around. So it's an awesome business, and we can do some great things. So I appreciate you including me.
Appreciate it.
Be well, everyone.
Entrepreneurs make mistakes, but with the overwhelming amount of free information out there, you don't have to be doomed to making those same mistakes. You just have to find a consolidated version of the most important information. What if I told you I'll gift you all of my DD mistakes I've made over the years for free? Just leave me a 5-star review, screenshot the review after it goes live, and email it to me at my website, archimedesgrp.com. Afterwards, join our Facebook group, Mobile Home Park Mastermind. You'll find hundreds of other mobile home park owners sharing ideas, contractors, and deals. It's free to join, and we would absolutely love having you join us.